and we have been joined by economist with Data Bank Courage Mate for more on this budget review that was held yesterday. Thanks so much for your time this afternoon, Courage.
Good afternoon, Sandra. Thanks for having me.
It's been a while. How are you doing?
We are keeping safe, we are keeping alive, and hope you are as well.
Very well, thank you. Our debt stock is rising. Sure, this was nothing new. We were expecting this due to the impact of the pandemic. Mind you, our revenue gap is also very wide, and oil revenue projections also came down, totally crashing because of crude prices coming down on the world market. Looks like government was left with little or no option. But the bigger question most people are asking is, what is our ability to pay back this debt? Should we be worried?
Well, generally we should be worried, right? Because our debt stock is going to climb sharply. And once your debt stock climbs sharply and your revenue is moving in the opposite direction or not growing as fast, you should be worried. So on the face of it, yes. And the creditors who are giving you the money, whether they are capital market investors, bilateral creditors or multilateral creditors, they are not going to forgive you the debt just because the increase was as a result of COVID. And we've always had this issue with debt sustainability. So we should be worried. But again, in the midst of all this, we could also be asking ourselves, what is the alternative? I mean, if you have revenue falling so low and you also have to save the economy as well as lives, and what you have to do that is not sufficient, it's a given that you have to borrow. It now has to be the question of what kinds of borrowing are you doing? How sustainable are the borrowing? And then it comes back to our ability to pay back. And so the cost of the debt has to come through. If you look at the budget, the revised budget that was presented yesterday, it gives a certain indication of the fact that, yes, the government admits that the debt would rise sharply, but then the new debt must come from low-cost sources. So you notice that the external funding is coming from interest-free IMF funding, low or concessional funding from the World Bank, and then concessional funding from the AFDB. When it comes to the domestic borrowing, they are doing 10 billion cedis from the Bank of Ghana with 2 years moratorium, giving the government space to put finances together before they start paying. And the ones that they have to do on the open market, you will notice that since April till date, we've seen interest rates on domestic bonds going down. So that at the start of May, a 3-year bond that went for 21% went for 19% in June. So you see that even on the domestic market, they've tried to cause interest rate to fall so that the borrowings they will do would happen at a lower rate. So in summary, yes, the debt will grow and it's a concern. But what they are trying to do is to show that the new debt would come in at a lower cost.
Said that, yes, of course, we are borrowing at a lower cost and also having longer time to pay for this problem of how we are going to mobilize funds to pay back this debt. Is that enough?
The terms of the debt in itself does not solve the problem. They are supposed to buy you time to organize your economy and your finances to pay back. And so if you do not invest the money in productive ventures, and also I must emphasize that the situation we find ourselves in gives the risk or increases the risk of spending on consumption rather than production. So we must ensure that we do not fall for that risk. We must ensure that we spend on productive ventures so that during the period, the longer tenors and the flexible terms that we are securing on this debt, we put our house together and be ready to service the debt without difficulties when the time arrives.
Courage, looks like there's a new trend when it comes to our bonds. Previous government have had to fall on short-term bond, and then the current governor appears to be having a trend with long-term bonds. If you look at it, is this also to buy time for us to be able to turn around, use the money wisely and pay? And in your opinion, which works better, the shorter one or the longer-term bonds?
I mean, the longer one is obviously the way to go. And we also need to emphasize that this strategy started from the previous government. You recall what we know with the previous finance minister as smart borrowing, the term smart borrowing. And with the current minister, we have what we call the reprofiling. It's all the same strategy of increasing the tenor of the debt and also getting as low interest as possible, so that you get time to increase your revenue inflows to service the debt. When you do short term, what you're doing is that they mature frequently and your finances do not improve in tandem with the maturities. And so you are locked into rolling over at a higher cost. And so you tie yourself into a debt distress, a risk of debt distress. And so it is better to go long, and if it is possible, at a lower cost.
All right. I believe this new debt stock includes the 8.2 billion financial sector cleanup and also the cedi's depreciation. I'm sure many are wondering why the cedi continues to depreciate, exporting less during this period because of the pandemic. Has this got anything to do with capital flight and also the role of multinational national companies?
Yes. So a quick context. So the depreciation of the cedi would to some increases in the debt portfolio. But thankfully, the pace of depreciation we've seen this year is quite moderate, 2.4% as at half year versus over 8% same period last year. It would have been worse if we had last year's pace of depreciation. But that said, you would also recall that during the first quarter of this year, the cedi actually gained, which would have been better. But then towards the end of the first quarter and into the second quarter, it started losing because foreign investors on our market started liquidating their positions and moving out. So even though we are importing less and it is helping our balance of payment position, between end and second quarter, we've seen a sharp decline in foreign investor holdings. For instance, domestic bonds, as at the end of quarter one, had 27 billion cedis in the hands of foreign investors. But at the end of quarter two, 24 billion cedis. That is a reduction that demanded dollar to exit, and it put that pressure on the cedi to move from a net appreciation quarter one to a net depreciation of 2.4% quarter two, and it contributed to what we saw.
So what is the likely impact on our cost of credit in all this?
Well, the hope is that the Bank of Ghana will continue to monitor the exchange rate, and it has had a firm grip on the exchange rate so far, and we are hopeful that it will maintain that firm grip on the market. And it's done marvelously well in terms of restructuring the foreign exchange market with the forward auctions that it has been doing, and it has been very helpful. So now we need to ensure that if the exchange rate remains stable, then the cost of this debt will also remain stable, because what we've seen is that there is a strong correlation between yields or interest rates on the market and the exchange rate behavior. For as long as the exchange rates remain stable, we expect that future debts that are being contracted would also be coming in at a manageable cost.
I want to say a big thank you this afternoon, Courage, for joining us with your thoughts. Thanks so much. One second.